Judging the success or failure of actions by the European Central Bank is usually pretty easy. Just look at the euro. The euro's exchange rate is not in itself an official, explicit target for the ECB, but a weaker currency certainly helps to support inflation, something that's seriously lacking at present. Drops in the currency are seen as a big thumbs up. This time around, though, the currencies market hasn't played ball, feeding somewhat wobbly conspiracy theories of a G20 plot to push down the dollar. The euro leapt after the ECB souped up its easing measures in early March, and it's stayed there since, against the dollar at least. It's also carving higher against the pound, thanks to persistent nerves over the UK's EU vote in June. But that's not to say the ECB's cut to the deposit rate, enhanced bond buying programme and new efforts to fire up lending have gone unnoticed. The corporate bond market is on full-on party mode. Yields have collapsed, which is the flip side of rising prices. On average, they're now well under 1%. Companies are taking advantage of super low issuance prices and hitting the market with new paper at a record clip. Last week was the biggest ever for euro-denominated corporate bond issuance, with over 30 billion euros hitting the screens. Will this help the ECB to do its job? The answer depends on who you talk to. Some think it's unrelated to inflation, which will pick up only when oil prices really do. But most agree it can't hurt. If all goes to plan, it should be one of several factors that does what the ECB really wants, which is, of course, getting that inflation back on track. It should at least help to foster investment and growth, eventually at least. The central bank still might start squirming if the euro keeps cranking higher, though. How much it can climb above 120 to the dollar will be interesting to see.